Thank you for joining us for our Financial Lens episode titled Tax Planning Tips. One thing that I have found in my career as a financial planner is that often clients will have the same investments in their IRA as they have in their non-IRA account. Personally, I think that's a mistake, and I'll tell you why. You see, when you have investments, there are two ways that they will be taxed. They will either be taxed as ordinary income, or they'll be taxed as capital gains. Capital gains include such things as property, it will include such things as stock, and the items that are taxed as ordinary income are such things as interest income, and it will also include investments in the category of annuities. Well, we know that any investment that's in an IRA account will be treated as ordinary income when a distribution is made. So whether it's a stock, a bond, annuity, a real estate investment holding, REIT, anything, when the distribution is taken out of that, that is going to be treated as ordinary income. Said another way, if you have a stock in a IRA, you are not going to have the opportunity to have that treated as a capital gain. We also know that if you look at the category of annuities, are always taxed as ordinary income. Whether they grow in an IRA or a non-IRA, the interest is going to be taxed as ordinary income. What that means is when we have an annuity in a non-IRA account, that's going to be taxed as ordinary income, just like it would be taxed as ordinary income if it was in a tax-qualified IRA. When we do allocations, it's very important to have the total allocation of riskier and safer investments be set up properly, but we also want to see how those individual investments are going to be taxed. So when we have equities, we want to, as much as possible, put those equities in the non-IRA holdings because we want to experience the capital gain from those equities. And if we do have annuities in our portfolio, as much as possible, we want to have those investments in the IRA account so that they'll be treated, of course, as ordinary income no matter how they're titled, but we want to free up more opportunity for equities to be in the non-IRA account. Let's take a look at tax windfalls and blunders that sometimes folks make related to their taxes. The first thing we want to talk about is the primary residence of individuals. One thing to keep in mind is if we have a primary residence and we have lived in it in 2 of the last 5 years, when we sell it, we get a step up of $250,000 per owner, $500,000 per couple in that gain in the sale of the house. We have a potential significant tax savings. We may want to consider where we live prior to selling the home so that we can take advantage of that $500,000 deduction per couple for the capital appreciation of a primary residence. The other thing we have to keep in mind is there is a step up in cost basis upon the passing of the owner of the asset. This is under current laws, under the current IRS regulations. What that means is when someone passes away, the growth of the stock, the appreciation of that asset is not taxed to the heirs. So if someone were to have some appreciated assets and they were to sell them, they'll pay taxes. However, if they pass away, that gain in that asset is not taxed. So it's important, and I'm sorry to be somewhat blunt about this, is when we have couples that own assets jointly, sometimes we want to put that asset into the ownership of the spouse that's more likely to pass away sooner. A mistake that often people will make is to gift appreciated assets, and the most common is a house. It's very common for individuals to gift their house to their children or sell to them for $1 because they want to protect that home from nursing homes or nursing home costs. What they do when they gift that house is they gift that cost basis. So let me explain. Let's assume that a client purchased a home for $50,000, maybe many years ago, and that home is worth $500,000. By gifting that home to a child, what they gifted is that cost basis. And so it's deemed that that child acquired that home for $50,000, which is what that original owner paid for it, and that individual loses that potential of step up in cost basis for $450,000, because if that child were to receive possession of that home upon the passing of the parent, there would be no taxes. So it's a big disadvantage to gift assets that have appreciated to heirs. Another thing we want to look at is the difference between tax brackets for married filing jointly and single filers. Very often we'll look at couples that are looking to keep their taxes low, reduce their taxes, and then what happens is when one of those spouses pass, the spouse that's left, the surviving spouse, will be in a single taxpayer category. And very often, the income will not drop all that significantly. So what will happen is that single taxpayer might be in a much higher tax bracket. It's important to consider tax bracket planning for couples and looking at what will be the tax impact when one of the couples passes. So we may want to pay some additional taxes when couples are married so that when one of them pass, the surviving spouse will have to pay less. The last thing we want to talk about is beneficiary IRAs. The tax code has changed, and beneficiaries of IRAs, by and large, have to cash out the IRAs over a period of 10 years. This does not apply to spouses. This applies to individuals who are at least 10 years younger than the owner who passed away and are family members. But these individuals will have to pay taxes out or have to take their IRA out that they inherited at a fairly sizable clip, and that might create a big tax liability. I know many of my clients say, whatever's left is left to my heirs. That's up to them, and if they have to pay taxes on it, then they'll pay taxes on it. That is a valid argument and certainly a valid strategy. However, if you know you're going to leave assets to your loved ones, to your children, it might make sense, and especially if you're not going to use those assets yourself, to pay the tax liability for them while you are alive so that when they inherit the money, much less will go to the government. So thank you so much for listening to our Tax Planning Tips Financial Lens episode.